Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Dugan Kelley. Thanks for being on the show, Dugan.
Hey, thanks, Whitney. Hey, everybody.
Yeah, I'm honored to have you on the show. And a little about Dugan. He is one of the country's leading syndication lawyers, holds offices in Texas and California, servicing clients throughout the United States in all phases of real estate acquisitions and sales. He structured deals in excess of $2 billion for clients and is the best-selling author of Purpose, Passion, and Profit. Dugan, thank you again for your time and being willing to come on and share your expertise with us. Give the listeners a little more about yourself and let's dive in.
Thanks, Whitney, for having me on your show. I am a syndication lawyer. I have offices obviously in the Texas area and California area, but most of our clients hunting for deals in the syndication space in hot multifamily markets around the country. So whether you're looking in Florida and Georgia or Texas or Arizona, we have clients all around the country that are looking for hot multifamily opportunities, and we kind of help them. So from acceptance of your LOI all the way through to the closing table, that's what I do primarily for my clients.
Nice. So, I mean, somebody like yourself is such a crucial team member of any sponsor or anybody in this business ultimately that's doing deals like we're doing, because there's so many legal things that we need to know about, but I'm never going to be an expert on the legal side. And that's why I'm going to have somebody like yourself, right? I mean, there's just no way. And I don't want to be, but I want to be proficient. I want to obviously be certain that I'm operating, as legal as possible. I know the listener does as well. But one thing.
Short.
What's that?
Don't sell yourself short. I know that as a seasoned syndicator yourself, you probably know the vast majority of everything that your lawyer tells you. You've probably heard it 1,000 times before.
I have heard a lot of it. It's still like, I just want to ask just to hear it again or make certain, But, one thing, Dugan, that everybody has questions about, and it seems like it seems to be this, quote, gray area, end quote, that a lot of people wonder about is advertising deals and putting out deals and what, some guidelines there, making certain that we're doing that properly. Obviously, I see deals advertised all the time, whether it's on social media or my email, or, I'm sure you do as well. And I just would love for you and I to dive into that a little bit and provide the listener a little more clarity.
Right. Yeah. That's a great topic for your listeners. There's a lot of ambiguity and confusion in the marketplace about what you can do or what you can't do, in particular on social media. And so, the primary two exemptions, and when I say exemptions, the primary two exemptions that we're applying for most syndicators are Reg D under 506 C or 506B of the SEC Act. And one of those allows us to advertise broadly, solicit. You can put billboard, radio, do anything that you want. That's 506C. But the vast majority of private syndication, private offerings in the country still are under 506B, which allows you to do accredited investors and then up to 35 sophisticated investors that you have a pre-existing relationship with. But it does not allow you to advertise. And so sometimes when people are posting on social media or they're pushing out on their own profile on LinkedIn or things like that, they may be 506C offerings, in which case there's not an issue. But to the extent that there is 506B offerings, or the people are involved in a 506 offering and they're pushing that out on social media, that's what we would call a non-compliant advertising. The SEC has a general prohibition against solicitation. And the reason behind that, and I always encourage my clients to understand the reasoning behind that, is very simple, and that is we don't want to advertise to people that we don't know when it's not a 506C offering. We want to make sure that we have a substantive pre-existing relationship with them such that we would be giving them all the information necessary in order to make a determination as to whether the investment is a suitable investment for them. So that's why you see sometimes here, hopefully, tells you, hey, don't post that or take that down. Maybe you've crossed the line a little bit. So we want to follow the rules, but we also want to understand kind of the background behind the SEC has a rule against kind of advertising any particular deal.
So you touched on their pre-existing relationship, and it's so important. And I just wonder if you could just define that a little bit. Maybe what determines that? I've heard different scopes of that. From one end to the other. I know some people have a standard of, okay, I want a phone call with every investor before we ever allow them to see a deal or invest with us. And I've heard other people say a connection on certain social media channels could be considered a connection through the SEC or a pre-existing relationship. But if you could just elaborate a little bit on that.
Right. Yeah. So we used to think, this is years ago, we used to think that there was some sort of magic time limit that you needed to know somebody for some period of time before you develop this kind of magical, substantive pre-existing relationship with the potential investors such that you could potentially discuss a potential offering with them. That's not the case. The SEC is clearly told us through what they call advisory opinions or no action letters that there is no magic time frame for the development of a substantive or a pre-existing relationship with a potential investor. It really boils down to whether your relationship is substantive enough so that that the potential investor's business expertise or experience, that they have enough of that in order to fully evaluate the risks of a potential investment opportunity. So if you don't feel like you have enough information or enough contact or enough life history with that potential investor such that you would even understand that they could fully evaluate the risks associated with that potential investment, you don't have a pre-existing substantive relationship with them. If you do, you do. So it's kind of, I wish that there were, if you have to go out to dinner with them 3 times, or you have to sit with coffee with them for 5.5 times. It just isn't, the SEC just doesn't come out with that type of guidance. Maybe they will at some the future, they just haven't so far.
So as far as social media posts, I wonder, between like the relationship with you and a client, is that something that, as a client, that you would review? If I was sending you, well, all right, Dugan, we're looking at maybe posting these posts about, this subject or our business, and just to get, here's a couple, are these going? Could I get your opinion? Is that something that from your standpoint that you all do?
I do. I do that for existing clients, long-standing clients that have concerns over this, or they have a very large or broad audience like yourself, or somebody else that has a large social media platform, and there's a temptation to say to really figure out where's the line between education and just generic information about my company and what it does versus what we call preconditioning the market. We don't want to be conditioning the market, meaning is the intent behind the post designed to solicit or elicit potential new investors to come to me. That's what we call a preconditioning market, and that's another kind of no. We don't want to precondition the market, but what we do want to do is we want to be able to share honestly, transparently, authentically share information about the great things that are going on with our company, the positive things, the things that we do generically, so that otherwise, how would people ever discover you other than just kind of you going and meeting them, pressing the flesh, so to speak, at events or meetups or things like that. So sharing information, generic information about your company, what it does, that's fine. And being excited about being in this space and the blessings that come from being able to provide, for your investors, that's fine. But talking about specific returns or a specific offering or a specific property or things like that with the intent to try to drive more traffic or more potential investors to you, there is a line there that you don't want to cross.
One example is, that I see often, and I've heard conflicting information or about these types of posts, is like, we've closed on a deal. Right. And I just wonder, your opinion as far as, I blast out to our network, because we are excited about it, right?
Right.
That we just closed on a deal, and I've heard some attorneys will say, nope, you cannot do that because your investors already know that you've closed on a deal. So the only reason you would do that would be to solicit, more investors. And then I heard other attorneys say, well, it's just fine. It's already done. It's closed. So you can talk about it. So I just wonder.
Right. Yeah. So, I tend to look at it from a pragmatic standpoint, right? So people are people. You're excited about closing on an acquisition. I don't see anything wrong with saying, hey, just want to thank everybody that participated in helping me or helping our company get to where we're at. We're just so excited that we just closed on another acquisition. There's nothing wrong with that. I think that's perfectly understandable. That's part of the human condition. Everybody wants to express joy about actually doing that. Many of my clients, and you probably know this yourself, when you are doing this day in and day out, it's sometimes you don't stop and savor just the victories, the small little victories. Right. It takes a lot of effort, time, money, resources, everything to close on any one of these deals. So when you close on something, it's perfectly understandable to be excited about it because the massive amount of effort, teamwork, people, sheer energy and resources that it takes to close these things is crazy. And so being able to share that with people that you know, that you love, that you trust, that are supportive of you, totally understandable. What I think where it crosses the line is where when you would post something like, hey, our investors are expected to receive, 12% cash on cash, first distributions to roll out next month. Those sorts of things clearly are designed. The only reason you theoretically would be sharing that type of information would be to elicit a kind of a further response from somebody that you theoretically don't know and drive them to you. Now, if you're doing a 506c offering, great. But if you're historically primarily in the 506b space and that's what you just did, that's not, I don't use the terms like illegal or criminal because that scares people and we don't want to operate with the spirit of fear, right? We talk about words like compliance and non-compliance. The law is there to help us. It's there to help us provide a guide and bumpers so that we know that we play inside of this space and we don't want to be non-compliant. We don't want to violate the statutes, but we want to also not be so fearful about just the blessings that we've had and the acquisitions that are coming or maybe the potential sales. You might want to blast out, just basically say, hey, we're just so glad that we actually sold one of our assets, right? So I think those things are different, right? From intending to drive investors to you as opposed to just sharing the good things that your company is doing.
And as far as that social media post, so we, it's okay to put, we closed, we're excited. However, I've seen some at the, the last sentence say, if you want to get on the next one, contact.
Right. Yeah. Just drop that last sentence off. Don't, for those of you that didn't act quickly enough, call me. Right. Yeah. That's not, that's where the editing tries to be there. And listen, understandably, that's also part of the human condition, right? You want to be able, when you've done something great, you want to be able to try to encourage new people to come in. The problem with that is it runs afoul of the compliance aspect of it. And that is we want to only be talking to people that we already have a pre-existing relationship with, so about a potential offering. So if you have a potential offering and you do not have a pre-existing, meaning it existed prior to the offering in live, then don't share that information with those potential investors.
One thing that has made me successful is something that most people don't think of. It's the way that I've branded myself online. If you want to brand yourself to raise more capital, then I suggest working with my friend Adam Adams. So go ahead, scroll down, and find the link in the show notes. So, of course, I follow some other operators that I feel are operating at a high level, and I know others do this to me as well. But get on their list and potentially maybe even invest in some of their opportunities, as well. And a lot of it's to learn from them, and I know people that do that with me as well. But I noticed at the bottom of a lot of email correspondence, it will have the 506c like statement or regulation or something about that
right.
all their offerings are 506c or something like that. And so if we're doing a 506c offering or producing something like that, should we have some kind of statement like that on our emails?
It's that, again, it's not there's no magical requirement for you to do that, but I think that's best practice. It's best practice for you to tell potential investors, especially seasoned investors, seasoned real estate investors that invest over and over and over again. They know what 506B is and they know what 506C is. And so if you're a young operator and maybe you've crossed the line or you've started to push out or unintentionally advertise or potentially make some mistakes in that area, that's a real estate investor who's seeing that triggers maybe a potential little warning sign with them that they may not want to necessarily invest in your deal. Not because it's not a great deal, but because if you don't understand just some of the basic framework and the basic rules associated with this, how could they theoretically trust you with the bigger things, right? The bigger management issues, like did they select the right PM? Is the pro forma, the projections that they have in the offering, is that legitimate? Or are these kind of like made out of whole cloth? Those types of things is kind of an erosion of the credibility potentially with your operators and your passive investors. So I tell people best practices, if you're going to do a 506c opportunity, take advantage of the fact that it is a 506c opportunity, and tell your potential investors, which will be potentially maybe new investors that have never invested in multifamily before, that you'll be able to kind of evangelize to, so to speak. And then others will be seasoned investors. And when they see that 506c opportunity, they'll know, hey, this is totally legit. This is compliant and your advertising is fine.
Are there any examples that come to mind of either, really good, I don't know, ways that people have promoting themselves that you really prefer, or maybe improper advertising that you've seen that maybe some people might feel is okay, that you've seen that that we should be aware of?
Yeah, I mean, I think that some of the I know that you have partnered with and you're a top flight operator yourself, but some of the ways that people promote when they are doing a 506 opportunity, they take advantage of all their diversified channels of distribution, if you will, to potential audience, whether it's a podcast, whether it's whether it's your LinkedIn page, whether it's Facebook advertising, or whether it's your personal Facebook page, whether they create a new Facebook group, or whether they're advertising a meetup where they theoretically would be discussing a potential 506c offering. Those are some of the diversified channels. You're really only limited by your lack of creativity, right? So some of the operators that are more creative, or that they have team members that are gifted in that, are so inclined in that area, they have thought of lots of different ways in which to get out their message and the potential legitimate 506c offerings. And then you've got people that are young, maybe potentially new operators that don't fully understand 506B, 506C. They're really excited about, they've got their first deal or whatever, and maybe they're pushing things out on their social media that they shouldn't be pushing out. So I've seen it all. I've seen it all. And I think, but being attached, right? I say this is a team sport. Nobody does this themselves. The reality is we're syndicating, meaning we're pooling other people's money in order to get to the down payment, in order to acquire the loan to buy the apartment building. That requires other people. Because if we're not syndicating, we're just using our own money. We just show up at the closing table and we say, here's our couple $1,000,000 for the 20% or whatever the leverage is that's required of us to get to the loan to buy the apartment building. But when we're syndicating, we have other potential partners or other partners that are helping us along the way. And so we need to kind of tap into both the creative juices as well as potential warnings that come along with our potential team members that maybe they say, hey, this is a 506B offering. Let's not do that.
From the legal aspect of this business or the syndication business, what do you see as the hardest part for most operators?
Raising capital. Raising capital is the number one thing, and it is it's the most difficult thing to do. The reality, though, is that most people are better at it than they think, because most of us have people in our lives that are potential investors that know, like, and love and trust us. And people invest with people that they know, like, and trust. And so I think getting over that fear factor, if you're a young sponsor or syndicator, and getting to that place of like being able to ask somebody for money legitimately to help, right? The purpose by asking a potential investor to invest in one of your deals is not to help you. If that's your mindset, then you're always going to struggle with raising capital. But if you have a servant mindset of how can I help the potential investor get to where they want to be, you're going to be much more successful. So when I see young operators, they have that shift, that mindset. That's perfectly natural to think, how can the potential investor help me help invest in this deal so that I can actually get and own it? But the reality is, your mindset needs to be, how can I serve the people that are in my life, the potential investors in my life, in order to be able to deliver maximum value to them? When you get to that point and you get over that kind of fear hurdle of asking somebody and telling them, somebody that you've known, I think there's a massive acceleration for most young operators and want to be syndicators.
Are you a real estate investor as well, Dugan?
I am. I invest. My family's my family has long invested in real estate. My parents were primarily ministers, so they did not have the net worth and a lot of money coming in from their day job. They were urban missionaries for the most part for a long time. Dad was very astute early on, and he invested in real estate, and that is how they primarily paid for their expenses, like pounded out the light bill and put food on the table was through investing in real estate and getting the passive returns. And so I'm a big believer, because I'm a product in part from my parents, the benefits of investing not only passively but also owning other pieces of real estate where you don't actually live, but commercial real estate that generates income that you theoretically can provide for your family.
And how do you prepare for this potential downturn?
Yeah, so I ask that a lot, and I tell clients, I said, those of us that have been doing this long enough, that lived through 2007, 2008, when the entire financial world just changed. I think that if there is a market correction, I'm not seeing it on the horizon, by the way, but if there is one, I think that the vast majority of investing in multifamily is still going to be fine. I'm not talking about A-class properties. We're talking B and C class. Most of the syndication in the space is done kind of on value add or B and C class properties. So as we see the baby boomer generation, we're an unprecedented amount of population of aging adults and millennials that don't necessarily want to buy their own home. They all have to live somewhere, right? You don't have to work anywhere, particularly, meaning if you're a young professional or even a seasoned professional and you own your own office where you work, you don't need that necessarily. That's not a necessity, but you have to live somewhere. And so I think the idea that we're going to see some sort of massive market correction in multifamily, especially in the B and C class, I don't see it. If anything, there will be a higher demand now in when the economy kind of tanks or it goes downward. You see maybe longer hold times. Maybe you'll see longer hold times and not as much liquidity in the marketplace from buying and selling. But you're going to see a lot of seasoned real estate investors, operators that are cash rich, being able to take advantage of the opportunities, and they're still going to be buying, meaning that's going to be the time to buy and be in acquisition mode if you're an operator. But because you understand that it's not, those properties are still going to have people living in them. So I think it's still going to be one of the safest asset classes for potential investors in the country.
I appreciate you elaborating on that. I love your take on it and value that as well. But what's a way that you have recently improved your business or operations that we could also apply to ours?
Yeah, so I think waking up to the fact that people get information in diversified ways. I have not always been the best student at that. I've not always been the best steward of that. So when I graduated from law school and started practicing, I practiced law mostly with a dictaphone. I had a dictaphone and my admin would physically type my letters. And so from that to now, my gosh, your smartphones, podcasts, social media, all of that, I'm still, I think, a neophyte in many of those areas. But I think that is something that we're making a diligent effort on in our space, in the legal space, to be able to help serve others, to be able to pour money and resources and time in my firm, help develop those areas of diversified kind of services in the technology space, because for the vast majority of my career, most of my clients come to me by word of mouth, not necessarily by technology. But as technology develops, I think it's essential, especially for young operators, and they're often the best technicians of that because they grew up in a different era of, it's like second nature to them than to people like myself who are like, oh my gosh, what's the latest thing that I need to learn, how it works and how it necessarily applies and how I might implement it in order to serve my clients better.
So as an investor, and also, from your experience as an attorney, what's your best advice for caring for investors in a manner or in a way that they want to return to the next deal?
Yeah, I mean, I think that relationship, that key relationship, you'd be a better person to answer that exact question. But investors, I find, if they know, like, and trust you, and even if you have bad news to impart to them, if you've done this long enough, one of your is theoretically is not going to perform at the level that you project. That will happen. Okay, don't freak out when that happens, but be honest, be humble, be transparent with your potential investors. If you're honest and humble, even when your chips are down, even when you feel like you've got punched in the mouth or you're lying in the ditch or one of your deals goes south, that's the time to step up, I think, and share that with your investors. Because I don't know about you, but I find it personally attractive and personally just inspiring when I see somebody share a challenge that they have gone through and being able to overcome that, or even if they're in the midst of the challenge, and ask for your grace, for investors to extend grace to them. That often is more appealing to investors, because investors are not dumb. They know that that investing is no guarantee. There's going to be a potential roller coaster. We all want this kind of curve that goes up, but the harsh reality, life's not like that. Right. Life is full of ups and downs. But if you're steady, you're honest, and you're transparent with your investors, is the best key to long-term success with them.
All right, just a couple more questions before we run out of time. But what's the number one thing that's contributed to your success?
Hard work and diligence and listening. Like, honestly, listening to. I had parents that loved me, and thankfully, I was blessed with parents that gave advice, and I listened to them. And I tried to listen to my friends, and I tried to listen to the people that the Lord put into my life to be able to inspire me to the next step. And then I had a mindset that if I was afraid of something, not stepping out in traffic or something like that, but if I was afraid of something, because we're all afraid of something, that I would have the courage to step forward in faith, believing that through hard work and diligence, you would overcome that challenge. I think those components, being able to listen and have a great work ethic, are the two things that help drive me forward.
And how do you like to give back?
So I sit on the board, a number of nonprofit boards, one of which is, is Treasured Vessels Foundation, where our mission is to stop human sex trafficking, particularly here in the Texas area. And so I sit on that board. We give back to that organization, and then my folks obviously have a number of faith-based organizations that I'm plugged into, that I contribute time, resources, love, and affection for people that are associated with the causes that are near and dear to mine and my wife and our children's hearts.
Dugan, great show. I appreciate you so much and your time and sharing your expertise, because I know this advertising discussion is needed, and so many people are wondering a lot of these things that, what they should do, that you laid out very clearly for us today. I'm grateful for that, and I know the listener is as well. Tell them how they can get in touch with you and learn more about your practice.
Yeah, I would love to, Whitney. Thank you so much for having me on your show and sharing this with your audience. So if anybody would like to get in touch with me, you can go to our website. It's kellyclarklaw.com, or you can send me an email at Dugan is my first name, Dugan at kellyclarklaw.com. Thanks, everybody.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.